Good afternoon, everybody. We are going to do our weekly recap from the markets this past week of FOMC and the last full trading week of the year. And then we're going to go through some of the things that we look at and try to help you get better prepared in the markets. When I think of my kids, or I think of just the markets in general, my kids love to play the game of Clue. And we always go through the cards trying to see, following the facts, following who has what cards so we can do process of elimination to win the game. And in trading, you're going to do much better following the money, not following your emotions or following a guru that's giving you a narrative as to what's happening or why something happened, but understanding why the flows in the market change, just like a river changes its flow at times, faster rapids, slower rapids, the same way that the winds change. We want to follow the money and the hard facts to understand who is in control of the market. The other night, I was watching with my kids the movie Kung Fu Panda, and my kids have been on these videos before. You've heard them and heard their voices, but they get it. The illusion of control. When we watched this scene, they said, "Dad, that's like your work. You don't always know where it's going to go, but you know when you're going to do something." And those are the life lessons that my kids are trying to take away. But so many adults, we forget this. And you're then looped into all these other narratives about what's happening, somebody trying to tell you why we're panicking after the fact. So then you panic the next day and you get caught. Like on Friday, we were telling you, look for the move up. Everybody else on Wednesday and Thursday, after the move down, was telling you to look down, and we didn't go anywhere. We basically stayed sideways with more of an upside move on Friday and right back to our line in the sand where the big money sits. And so the question I want you to ask yourself as we dive into today is, are you observing or are you following? Are you following what MSNBC and what people on YouTube are telling you? Or are you learning to follow the money for yourself? If we think of there's been great trading books written all throughout history and great quotes from some of the best traders. Livermore talking about he made most of his money by sitting on his hands, not by buying or by selling, but by sitting. Michael Lewis in Liar's Poker talks about herding people into a corner and making them paying for their uncertainty. And Paul Tudor Jones says that intellectual capital will always trump financial capital. So are you increasing your intellectual capital? Are you understanding who's in the market, why they're in the market, what this is doing to price action so you can then be best prepared to trade it? Or are you getting thrown off and then trying to find somebody to tell you why something happened in the market just for the next day, not to be able to use that information? So today we're really going to dive into who's in the market and why. But first, just a quick reminder for you that derivatives trading is inherently risky and past performance is not indicative of future returns. So for the week ahead, commercials are still net short. And we talked about this on the NASDAQ, that we were looking for an open interest spike, but without that, we had the potential for an upside move, but we did have the signal for downside at a new 1 year and 3 year max short position or minimum long position, depending on which way you want to look at that. And the NASDAQ started the week off right at our upper rotational, made its move up to our upper pivot, and then right down to our lower zone before bouncing. And then again on Friday, we had our move through our entire lower rotational zone for 400 points. So if you know why to interact and when to interact and who's in control of this market, you can. The commercials on the SPX added to their net short by 50,000 contracts right ahead of FOMC. So if you think that this was an planned, uneducated move, that it took everybody by surprise, you have to realize the house is always going to win. That's the way the business is designed. The same way that Costco and Target and Walmart are designed as businesses. They can lose money on a single product. They can put something on sale and take a loss. They don't really care. But overall, they're going to win. Commercials can lose for a little while, and then we get that big whipsaw action, and they position themselves well for it, exactly as you would want to be for what was happening. And so some of the people that we watch in the market, the players that we watch when we're thinking of that game of Clue and the who done it, is it Mr. Green? We are looking at market makers, both short-term and long-term, fund managers, algorithmic strategies, death funds, retail traders, and margin balances. things we knew starting into the week were that commercials and non-commercials were net short, and the only player that was long were the smallest reportables. Fund managers were 100% invested. Death and algorithmic strategies were fully invested and actually trading on margin. Retail increased their margin balances by 40%. And market makers to start the week were in risk compression mode and distributing as they were adding to their short into FOMC. And large non-commercials were as well. So the big money wasn't really surprised by Powell. Just everyone else that waits for someone to tell them what's going on was. And so Monday, our line in the sand was at 60.50, which told us an upside day would likely be favored. There was a major catalyst a couple days ahead of time. And so how do you get people into the market? You know that people are going to buy protection into the event, and they were not insured at that moment. So we know that there's insurance premium going to be, insurance policies going to be bought in the market. And the way to get somebody to come into your store is you mark prices down. You put something on sale. How do we get those insurance premiums down? We move price higher. So Monday, we marked up the market to bring in customers. How do we know this? We anticipated this, expected this, and on Tuesday, we could see at the end of the day, we knew that that was likely what was going to happen. We went into Tuesday morning, so we went into Monday knowing that people would have to buy. You mark up the market to bring those insurance premiums down to entice people to come in. Tuesday, then, we're looking for that downward pressure. We're looking for that downside. Now, we also had our line in the sand at 61.12. That was key because that changes the market makers overall in the markets, and characteristically would change how price moves. So on Tuesday, we can expect that we're going to see downward pressure. At the end of the day, we confirmed that we had that downward pressure, and the price on Tuesday kept coming down. Where could we not break? Our line in the sand. So if you're tracking your clue card, you have the market makers giving you their clear signs. They are in control. They are holding their line in the sand. Chicago's phones are ringing, defending that. But we're marking the market up on Monday to sell it down on Tuesday, as we know that's what's going to happen. And if you know you can't break the line in the sand, you don't want to be close to that. So we move the market up so we have the room to come down. You need to pay attention to these because the money doesn't lie. The money and the flows in the market are all that matters. Price is what pays. The narrative does not. What you want to do is understand who's in the market, where that changes, where they come in, where they go out, and you can be more prepared than everybody else, and you can cut through the narrative crap that you hear from so many other people that are always a day behind. You know, we're trying to give you this in advance. And so as we come in on Tuesday pre-FOMC, we're looking for that downside. We get it right down to the line in the sand and then right back up. Now, Wednesday, what would we expect? The line in the sand is going to be our most important area to watch. That's going to tell us what the market makers are going to do. As long as we hold that, we can look upside. We had a willing buyer, and we'll get into that here in a couple slides. And we also had our VIX expiration and a catalyst. So we know that the most important area to watch is right here. As long as we hold this, when we come down, we can look long. And once we break that, we know instantly that's going to change the market. And that's also going to be our signal for our COT report. It was the last catalyst of the year. The FOMC meeting and the VIX expiration was the last catalyst on the calendar. The big risk is always going to be the black swan events. You know, the ones that you don't know, you can't prepare for. The known events, we can see how this price action is going to play out because the market is just another retail store. It behaves the same way any business would. So all this is controlled distribution, holding our line in the sand, staying above it until the FOMC comes out. Now, as we looked at our systematics and our death funds this week, as we came into Wednesday in the morning early, we are looking at a $10 billion bid early in the day. So as long as we stayed relatively neutral and, you know, within a couple percent of a move, so around a 1.6% move, we were going to see around $6 to $7 billion minimum being bought, and $10 billion as long as we stayed within the prior day's range. And then we look at our overall portfolio, and they are, no matter which way we look, they are fully invested and actually buying on margin. And so if we know that they're buying on margin, we start running out of buyers. We knew fund managers were exhausted. They didn't have the capital. Some of them aren't allowed to trade on margin. We knew that our systematics were buying on margin and our algorithmic strategies. We know that margin balances have been increasing. And so now it just comes down to our market makers and what is their agenda heading into the year? They're net short. They need to balance out that book. They have the perfect storm coming with the VIX expiration because the VIX had been artificially held down too low. You can watch our video. We put one out last year to explain the VIX expiration day at the end of the year. And guess what? It repeated again this year. So if you've been with us long enough, you could see that move coming on the same day, the same Wednesday of December. And if you didn't, go back and watch that video and you'll understand why this happened in the market. So we knew that the market was running out of buyers. So the only way to get that out is to shake some people out. And so we stayed sideways in that $10 billion node right until FOMC. Once we broke our line in the sand, we knew we needed to change our plan and look short. And we were looking under that 60.99, 6100 to get aggressively short. And that position paid very well on Wednesday. Then, as everybody was putting out videos telling you that the market crash was coming, all we did Thursday was balance. So if you're buying into that narrative, you are getting yourself sideways in this. And after a large move, you can expect it either to continue or look for that consolidation. And we had our consolidation day after that knee-jerk reaction. This was just a big flush. And how do we know that? When we put out our prep, right at the open on Friday, we told you to watch 60.50. That's our line in the sand. That would be the area where market makers are back to neutral. So if we flushed out, and again, remember, market makers have to trade. That is their function in the market. So as the market goes down, if nobody else wants to buy, they have to. Well, if you have to keep buying and you didn't want to, what are you going to do? You're going to move the market back up to sell it at a profit. And so we can see this washing machine. We've told you about this rinse and repeat going on over and over. And if you are getting too looped in to your emotions in trading, or too looped into what somebody else is telling you and not questioning it or not understanding why the market is moving, that money is actually the only thing moving the market, not the narrative that you're getting sold on YouTube or Twitter or X or on any of the financial media. Money and price are the only things that pay, and we can monitor a very large portion of these markets. And so the market was getting bought on Thursday. Some people will tell you short covering, which probably was some of that from the winners. I know we were in our room, but we also knew then that Friday was likely going to be the upside day as everybody's getting sold that narrative to look for the downside. And we checked on Thursday, and fund managers on this move down had puked out 20% of their portfolios. So again, we've seen now that our systematic strategies and our fund managers both drastically reduced their portfolios. Now we have the customers to come back in the market to propel us back up on Friday. And on all of this, all we know is, and we told you this, risk compression, risk absorbing. So when everybody's selling on the way down, our market makers are just absorbing, and buying everything between 5,900 and 6,000 to sell up to 60.50. And we saw this again, absorbing on Thursday and then getting your payday on Friday. We had our top level at 60.48 to 52. And I said on our morning video at 9:30 in the morning that 60.50 was going to be your key level. That's going to hold our key for the upside as we move forward. And we'll go over where that changes day to day if you stick with our daily preps, or if you join our professional room on Discord, we can go through any instrument that you would like. But all we did was come right up to our line in the sand before turning back down. This was a nice distribution move of all of this. And you can see we held over that Thursday range for this whole distribution. And the money doesn't lie. So that's what we always want to pay attention to. And if you don't understand where and why there are billions sitting at these points, then what is your edge? The narratives don't pay. Patterns can give you false signals as the market makers and size traders know how to paint the tape, but understanding the finances that moves the market and understanding where that group that actually has the money to control the market is positioned, then it's like seeing the business plan of your competitor before they go to market so you can front run them. So stop getting front run and start understanding how you can get the edge. The key to the Santa rally now into the end of the year is going to be the line in the sand. If we get over that, we can see the Santa rally. If we continue to fail that, then we're going to see the size traders continue to absorb until we get to the inauguration date at January 20th and Martin Luther King Day. Uh, you can either go down the river, if we go back to our early slide of the rapids, you can either go down the river with the narratives again that you're getting sold by MSNBC, to watch for a bend that looks like a witch's nose, or watch for that pattern, to know when to make your turn, or you can learn to read the waters and read the rapids so you can respond quicker, and during calm waters begin to take a little more risk. So for the week ahead, we will post our weekly plan to X. Daily plans will be posted on our professional Discord room for both NASDAQ and the ES. And it's also, again, a room where you can request specific plans. So if you're tired of following a narrative and being behind the curve, come check out our room of real traders navigating the market waters by using positioning that's giving us the peek behind the curtain. And as an added bonus, since you watched this video, we will give you how we are monitoring a portion of margin balances, and you can do this for free on the FINRA website. We look at multiple durations of change, and the rate of change over those, and we won't get into our specifics. But when we see an increase of 50% on one of our durations, that says the market is getting too euphoric. And we've gone back to the 90s. So we have about 30 years of data, and our current reading right now on our model is at 40%. The last three times we've crossed over 50%, December 1999. June 2007, and May 2021. Within a few months of each of those, we had a bear market take hold. Now, again, there's no guarantee that that will happen this time around, as we haven't triggered it yet. But we want to pay attention, and we will continue to monitor this and other metrics as we go for when that begins to get triggered, so we know when that market is hitting that euphoric point and when we can start then anticipating in the next 3 to 6 months a bear market to take hold. That is not now. Again, it has not hit those triggering levels for us, but we'll be watching this unfold in the coming months and year, and we'll watch that signal develop. Again, the head and shoulders pattern, the hammer or shooting star candles, or look below and fail pattern are patterns that can give you false signals. Follow the money, follow the game of clue and who did it, who has the money, who has the position. There's only so much money that is in the markets that can move around. Even when the government prints money, there's only so much it can do. So if you learn to follow the money and follow the flows, you cut through the noise and build your own business to front run those that keep front running you. Let's level up our game this year. Let's help you guys get profitable and help you all increase your knowledge so you don't have to follow somebody else's narrative, and you can follow the money for yourself and really take hold in 2025 of your own trading career. Have a great weekend, everybody. This is our last video for the year. We'll be back in the new year, and have a great holiday.